Welcome to the Opening Bell Report.
Today, we are looking at a set of numbers that honestly just shouldn't exist.
They really shouldn't.
Right. I mean, the old laws of physics for the hardware world. It's a tale as old as Silicon Valley. You build physical things, you deal with these incredibly messy supply chains, expensive factories, and you fight for just razor-thin margins.
Right. It's boom and bust, feast or famine.
Exactly.
It's practically the law of gravity for the semiconductor industry.
Yeah.
When demand is high, everyone builds factories, supply floods, the market prices crash, and margins just completely evaporate. It's the most predictable cycle in tech.
Yeah, it's been that way for, 40 years?
Easily 40 years, yeah.
Well, grab your gravity boots because the analysis report we're breaking down today claims that Micron technology has effectively turned off gravity.
They really have.
We're dissecting a report titled Micron Unbound, the 56% Margin AI Supercycle Thesis. And just to orient everyone listening, it is February 2026 right now. We are looking back at the Q1 earnings that dropped in late 2025.
December 17th, to be exact.
Right. And the numbers here represent what the report calls a violent shift in the economic reality of memory chips.
Violent shift. And that sounds dramatic, but it's actually the perfect phrasing.
It is.
Because we aren't talking about a company that just beat estimates by a penny or two. We're looking at a fundamental restructuring of how the semiconductor economy actually works.
So the central mystery we need to solve today for you guys is how did Micron, a company famous for selling commodity memory chips,
Stuff that usually has the pricing power of like soybeans or corn.
exactly.
Yeah.
How did they suddenly start putting up profit margins that look like a software monopoly?
That is the big question.
When I see 56% margins in the title of a report about a hardware manufacturer, my very first thought is, okay, who made the typo in the spreadsheet?
Right, because hardware is supposed to be hard.
And expensive.
Exactly. But it's not a typo. And as we'll see today, 56% was actually just the warm-up act.
Oh, yeah, the guidance is wild.
Even wilder. But before we get to the future, we have to understand the now.
Right. So the mission for this deep dive is to unpack this AI toll booth concept the report talks about. We're going to look at why this might not just be a blip, but a real supercycle. Let's start with the earnings bombshell.
Let's do it.
The report focuses heavily on that Q1 FY26 earnings release. Why are analysts calling this a shattered baseline?
Well, to understand the shock, you have to look at the raw numbers against what everyone expected. Let's just start with the top line. Revenue for the quarter hit $13.64 billion.
Okay, $13.64 billion. Give me some context there. Is that good, great, unprecedented?
It's massive. That is a 56.7% increase year over year.
Wow.
But the more telling number is actually the sequential growth, meaning compared to the quarter right before it.
Okay.
It's up 21%.
Just in 3 months.
Just in 3 months. For a mature company of this size growing revenue, 21% in one quarter is startling. It suggests an acceleration that large cap companies rarely ever see.
You usually see that kind of growth in a startup.
Right. Not a legacy chipmaker.
So that's huge top line growth. But, revenue is profit is sanity. What about the bottom line? Because you can sell a lot of dollar bills for 90 cents and have great revenue, but
you'll go broke doing it.
Right.
Exactly. And this is where the bombshell language actually comes from in the analysis. The earnings per share, or EPS, came in at $4.78.
Okay.
Now, Wall Street analysts who are paid millions to build these complex models to guess these numbers, they had the consensus estimate pegged at $3.82.
Wait, so they didn't just beat it. They missed the mark by almost a full dollar.
It was a beat of over 25%.
That's crazy.
In the world of institutional investing, a beat of that magnitude for a company this size tells you that the models everyone was using were fundamentally broken.
They just weren't factoring in how much leverage Micron suddenly has.
The analysts were looking at historical trends, but the history book had just been thrown out the window entirely.
Which brings us to the star of the show, the metric that's in the title of our deep dive today.
The margins.
The margins. This is what we really need to focus on.
The golden metric. Non-GAAP gross margin hit 56.8%.
Let's just pause and really unpack that for a second. 56.8%. For a software company like Adobe or Microsoft, that's a Tuesday. They
Right.
sell code. The marginal cost of selling another copy is essentially zero. But for a memory chip maker,
It's unheard of. You have to remember where we were just a couple of years ago. The report reminds us that during the memory glut of 2023, Micron's gross margins had collapsed to low single digits.
I remember that.
We're talking about making almost no money on the product itself just to keep the lights on and the fabs running. They were actively burning cash.
So we went from low single digits, basically survival mode, to nearly 57% in roughly 2 years.
Yes.
That is a 50-point swing. That doesn't happen in a heavy industry.
It doesn't. That is the core evidence that Micron is no longer operating as a traditional hardware fabricator. When you have 57% margins, you aren't selling a commodity anymore.
What are you selling then?
You are selling a scarcity. You're selling something that the market is absolutely desperate for, and you are the only one who has enough of it. It signals that the power dynamic has completely inverted.
Which leads us perfectly into the why. How does this happen? Did they just arbitrarily raise prices and everyone said, okay?
Not exactly.
Or is there something structural happening here? Because usually if you just raise prices, your customers walk away.
It is highly structural, and it creates what the analysis report calls a structural supply-demand imbalance. And the magic acronym here is HBM.
HBM, high bandwidth memory. We hear this term thrown around constantly in the AI space right now. But let's clarify for you listening, what makes HBM so different from the RAM sticks I put in my gaming PC? Why is this the golden goose?
Okay, think of standard memory, standard DDR, the stuff in your laptop, as a sprawling suburb.
A suburb, okay.
It's flat.
Yeah.
The data has to commute from the suburb to the city center, meaning the processor. It takes time. HBM, on the other hand, is a skyscraper built right next to the office.
Oh, I like that.
They literally stack memory dies on top of each other, sometimes 8, 12, or even 16 high.
So instead of spreading out, they build up.
And to connect them, they don't use wires on the outside. They punch holes vertically through the silicon itself. Those are called through-silicon vias, or TSVs.
And connect the layers internally.
Exactly. This allows massive amounts of data to travel instantly to the processor. It's like having a super wide highway with thousands of lanes instead of a single country road.
And why does AI specifically need this? Why can't ChatGPT just run on normal RAM?
Because AI models are getting so huge that the bottleneck isn't the computing power anymore. It's feeding the beast. The GPUs, the brain, they are starving for data.
They process it faster than they can get it.
They can calculate way faster than you can feed them information. HBM is the high-speed pipeline that keeps them fed. Without HBM, those $30,000 NVIDIA chips are just really expensive paperweights waiting for data to arrive.
So everyone needs HBM to make their AI work. But usually in capitalism, if everyone needs something, competitors rush in, they flood the market, and prices stabilize.
Usually, yes.
Why is Micron holding all the cards? Why hasn't the market corrected this?
Because they are sold out.
Sold out.
Completely. And not just backordered for a few weeks. The report highlights a specific detail from the earnings call that is just mind-blowing. Micron's management confirmed that their entire calendar 2026 HBM supply is completely sold out.
Wait, their entire 2026 supply.
Gone. Spoken for.
And remember, we are in February 2026 right now. So if I'm a big tech company, say I'm Amazon or Apple, and I decide today that I need more HBM from Micron for a project later this year.
You're out of luck. You literally cannot buy. The capacity doesn't exist. And here's where the economics shift. These aren't just handshake deals. These are non-cancelable multi-year contracts.
Non-cancelable. That changes the leverage dynamic completely, doesn't it? That puts all the risk on the buyer, not the seller.
Completely.
Yeah.
Usually memory buyers, the PC makers, the smartphone makers, they have the leverage. They can play suppliers off each other. They'll say, oh, Samsung is cheaper today, I'll buy from them. But now, Micron isn't at the mercy of the volatile daily spot market.
They aren't waking up and checking the daily price of DRAM to see if they made money today?
No. They are dictating terms. The report uses the phrase dictating terms to desperate hyperscalers.
Desperate hyperscalers.
We're talking about the biggest companies on earth, Meta, Microsoft, Google. They are lining up checkbook in hand saying, name your price, just guarantee me the supply.
That is a fascinating power shift. It's like Micron has set up a toll booth on the only highway to the future.
Yeah.
If you want to drive, you have to pay the toll.
That is exactly the AI toll booth metaphor the report uses. If you want to play in the AI economy, you have to pay the toll. And because the toll collector is sold out, they can charge an incredible premium.
Which leads to that unprecedented margin expansion we were talking about.
Exactly.
And the market for this isn't shrinking, is it? Because sometimes you see a spike in demand for a component that just vanishes a year later. Far
from it. This is the TAM acceleration part of the thesis. TAM stands for Total Addressable Market. The report projects that the market for HBM is going to hit $100 billion by 2028.
$100 billion just for this specific type of memory.
Yes. And significantly, that milestone is arriving 2 full years earlier than anyone previously expected. To give you some scale, that $100 billion figure is larger than the entire traditional DRAM market was back in 2024.
So the niche product has become larger than the whole industry used to be.
Exactly.
That really puts the scale of this AI build-out into perspective. It's eating the world.
Precisely. And it's not just about volume. It's about complexity. Making HBM is incredibly hard. You can't just flip a switch in a factory to make more. The yields, meaning the number of working chips per wafer, are much lower because of that complex stacking process we discussed.
So that creates a natural barrier to entry.
It does. It keeps supply tight for longer than usual because you just can't spin up a new factory overnight to meet the demand.
Okay, so Q1 was a bombshell, 56% margins, sold out supply. But the report argues that Q1 was basically just the appetizer.
Yeah.
That seems really hard to believe.
This is where the thesis gets really aggressive. If you thought Q1 was shocking, look at the forward guidance for Q2 FY26.
Lay it on me. What are they projecting?
For Q2, they are projecting revenue of approximately $18.7 billion.
$18.7 billion.
Remember, Q1 was $13.6 billion, so that's another massive jump sequentially. We're talking about adding $5 billion in revenue in a single quarter.
That's adding the revenue of a Fortune 500 company in 3 months?
Yep.
And the earnings, what about the EPS?
They are projecting EPS of around $8.42.
Wait, hold on. Q1 was $4.78. They are guiding for $8.42 in Q2.
Yes.
That's nearly double the earnings in a single quarter. How does profit double when revenue only went up about 40%?
It is nearly double, and that is driven by the margin expansion. This is the number that really makes you rub your eyes. The Q2 gross margin projection is approximately 68%.
68%.
68%.
I mean, that's not hardware. That's just not hardware. If you told me a company making physical items in a factory had 68% margins, I'd assume they were selling diamonds they found on the ground.
It's the software margin.
Yeah.
The report explicitly makes this comparison. When a hardware company guides for 68%, it forces Wall Street to completely re-rate the stock. You can't value them like a factory anymore. You value them like a software platform.
Because the efficiency rate is more than double the broader tech sector average.
Exactly.
But explain that to me. How is that mathematically possible? Even with high prices, don't they have massive costs to run these fabs? Fabs are billions of dollars to build.
They do, but this is the beauty of operating leverage. Their fixed costs, the cost to build and run the factory, pay the staff, keep the lights on, they stay relatively flat. Those costs are already paid for. But as the price of the HBM chips skyrockets due to scarcity, almost all of that extra revenue drops straight to the bottom line. It's pure profit. Once you cover the fixed costs, every extra dollar is significantly more valuable.
So they're literally printing money at this point. And I saw a stat in the report about cash flow that really drove this home.
The operating cash flow, it's hitting 53.6% of sales.
So for every dollar they bring in, more than 50 cents is operating cash flow.
Yes. That proves they can convert this top-line AI mania into actual bottom-line cash instantly. It's not just hype, it's cash in the bank.
Real money.
And that cash allows them to reinvest, pay down debt, or buy back stock, which just further supports the share price. It becomes this unstoppable flywheel.
Which brings us to the big question for everyone listening. Maybe you're looking at your portfolio, maybe you're just curious. The stock is trading near $428 here in February 2026. It's had a massive run.
Massive.
Is it too late? Is this growth already entirely priced in?
That is the valuation reality check section of the report. And it presents a really interesting paradox. If you look at the trailing PE, meaning the price to earnings based on the past 12 months, Micron looks expensive. It's sitting around 39x.
Right, 39x is pretty rich. Usually value investors get really nervous when they see a number that high. The S&P average is usually around, 20 or 25?
Exactly. But here's the twist. Because the earnings are accelerating so fast, remember they're doubling EPS from Q1 to Q2, the trailing numbers are totally useless.
Because they're backwards looking.
Right. They're looking in the rearview mirror while the car is engaging warp drive. You can't drive a race car by looking out the back window.
So we have to look at the forward numbers. What is the consensus saying for the full year?
The Wall Street consensus now projects the full fiscal year 2026 EPS to land between $32.45 and $33.05.
Okay, let's do the math on that. If the stock is $428 and they are going to make roughly $33 a share.
That puts the forward PE at roughly 12.5x to 13x.
13x, that's cheap.
Yeah.
That's utility company cheap. That's cheaper than the S&P 500 average.
It is incredibly cheap for a company growing revenue at over 50%. That is the disconnect. The report argues that despite the share price appreciation, Micron is actually trading at a massive discount relative to its projected future earnings.
Because the market hasn't fully digested that $33 EPS number yet, it feels like the market is still scared that the bust is coming.
Exactly. The E and the PE ratio is growing much faster than the P, and that's why analyst price targets are rapidly shifting.
Where are they heading?
The report mentions targets moving toward the $500 level, and the long-term bull cases, if this supercycle really holds, are looking significantly higher than that. The market is just playing catch-up to the reality of the new earnings power.
So to summarize the valuation argument here, it looks expensive if you look back, but if you believe the sold-out narrative and the 68% margins, it looks incredibly cheap looking forward.
That's the verdict. It's a trailing versus forward paradox. You have to trust the forward guidance to see the value.
This has been a wild ride through the numbers today. Let's take a step back and look at the big picture before we close out. We started with the idea of a violent shift. We've gone from a cyclical, beat-up hardware vendor to a high-margin AI powerhouse.
It's a complete transformation. We saw Q1 with 56% margins. We were looking at Q2 with 68% margins. They are sold out for all of 2026.
Unbelievable.
And despite the stock being over $400, the math suggests it's trading at a 13x multiple.
It really challenges everything we thought we knew about this sector. But I want to leave you with a provocative thought here. The report calls this an AI supercycle. It implies a long, sustained period of growth.
Right. The implication is that AI isn't just a trend, it's a new industrial revolution, and memory is the fuel.
But here is the question to chew on. If memory is now a bottleneck component with software-like margins, does this fundamentally break the old boom and bust cycle forever? Have we truly entered a new paradigm where physics and supply chains don't matter?
Or is this just the biggest, loudest boom we have ever seen, setting us up for an inevitable correction?
Exactly. History teaches us that high margins attract competition, like blood in the water. We know other big players are out there, so you have to ask yourself, can a hardware monopoly truly last forever in a market that usually races to the bottom?
That is the ultimate question. The report makes a compelling case for the supercycle, that demand will outstrip supply for years because of how hard HBM is to make. But gravity usually finds a way back in eventually.
Usually. But for now, Micron is certainly enjoying the view from orbit.
Indeed they are.
That's it for this deep dive into Micron's AI supercycle. Thanks for listening, and we'll catch you on the next one.
Don't forget to like, share, and subscribe for more.